I feel quite humble appearing after Saul. I feel like I'm an old man of economics, having been doing it for over 20 years. And then in the presence of Saul, who's been doing it for over 40 years, I'm very, very humble and following on. I will also, I'll take a lot of what Saul's given as background for what we're going to present today. There's nothing I could see in there that I could disagree or argue with. There may be a couple of points I want to develop a little bit further to bring emphasis towards PNG. But most of all, I wanted to highlight a couple of key things about PNG. But to do that, I'd like to set some pretty important background. One of it is, I think, Saul could disagree with me on this one because he's been around even longer and twice as long as I, but it does feel to me like I'm going, in some ways, back to the future a little bit. When I first became an economist through the 90s, it was a time of globalisation, deflation, the emergence of China. The world was changing rapidly. The Cold War had just come down, the Cold War had ended. These factors in the backdrop had changed the nature of the world, and I spent the first probably 5 years of my career arguing with old hands that not every signal was a sign of inflation was about to come. Not every signal was a sign that recessions were about to come, that central banks had changed their behaviour, that they were now being more proactive and they could prevent deep, meaningful recessions. So that took us to a disinflationary world. It feels the opposite now. It feels like we've done a lot of that work already. We're no longer globalising. In fact, on the edges, we're kind of de-globalising to some extent. China is no longer an emerging economy. It is a growing, wealthy economy. It's moving from being developing to middle road. It's moving from pushing people off the land into becoming more productive in the cities to trying to work out how you can lift productivity overall and go up the production chains. So it feels like we're moving from disinflationary to inflationary. We're moving from low, stable inflation, where inflation is lower and stable than what we were ever used to and we even thought it could do, to something being a little higher. Now, please, I'm not the stagflation hound. I am not talking about a wage price breakout. There are many reasons which I'll go into why that's not happening. But we are lifting up the structure a little bit. It does mean we're moving from low interest rates to higher interest rates. So you will have to think about those kinds of events and how they can impact on investments. But just as important, we're moving from carbon-based to non-carbon-based energy. Now, as a member of the finance sector, I'd highlight this is no longer about policy decisions alone. It's no longer about governments drawing up agreements. Businesses have decided that long-term investment in carbon-based energy is risky. Businesses are deciding that basing themselves in, particularly for like coal in particular, is not something they want to enter into because they're worried about stranded assets. Yes, LNG is a big important part of this transition. So at the moment it's getting a high level of demand, but we are in a transition phase and something that needs to be thought about. We've also moved into a world of a tighter global labour market. Globally, labour is in short supply, so there's no easy answer there. And one thing that we're experiencing in this, which is sort of capturing some of the inflationary pressures we're getting, is we've spent a long time in the last decade investing in experiences and things and high tech, all important things and things we need to continue to grow, but we've underinvested in infrastructure and producing things. And I've just said China is emerging to being less of a producer of things and more of a producer of experiences. So we're not out of the wood. So things in your back of your mind, just keep on thinking we're in a transition phase. It's not stagflation, not the end of the world as we know it, but the world is changing and we need to change with it. Good thing is PNG has come a long way in how it manages itself, and one of the most promising things we've seen is how it has managed the COVID situation. Yes, I know there's some issues around data, but overall it has been showing that PNG has been able to outperform Australia, outperform its near neighbours in terms of controlling COVID. There are some issues around vaccination rates. PNG has a lower than average vaccination rate and has some difficulties expanding on it. The government's doing a lot of work talking about how to grow and build through that and build the infrastructure to do so. But as such, the low vaccination rates do remain a risk for PNG, but not one that should be highlighted. I will skip over the next chart because Saul did such a good job talking about global environment, global risks. I take it all as given, and that'll be form the backdrop. But one thing I do want to highlight, for a small economy that imports a lot of goods, just like Australia, I spend a lot of time looking at freight rates and shipping rates. And one of the things I'm hearing from all the shipping companies is they'd be very surprised if they can get the rates back down to where they were pre-COVID. Yes, the cost of ships have come down as the global trade situation has slowed. The chart on the left-hand side is just showing you where the Baltic Dry is. That's the cost of moving ships around. That is back, but at levels to where it was a normal high. So it's still an inflationary level. Cost of containers is coming down quite rapidly, but nowhere near as rapidly. Why? Because of a lack of global infrastructure in the whole situation. Just as an anecdote, the US has got 10 years worth of investment in dredging out its ports to bring it up to speed to take the new modern big boats. It can't take them as yet in the majority of its ports. The containers are also being backlogged because of the lack of truck drivers, trucks, infrastructure in ports to move them around. Infrastructure that won't be invested in quickly and overnight. So yes, you've seen the peak as Saul's been talking about inflation. You can see reasons why it's getting better. And the global slowdown that Saul talked about is going to be part of the story. But we have elevated supply chain disruptions, as you'll see on the chart on the right-hand side. They eased post-COVID, and then as the world improved, they got tight again, and they're still elevated. That's that lack of investment in things that's creating this problem here. And so slow growth will improve it. You've seen the worst, you've seen the peak, it's getting better, but don't expect things to just go back to what they were pre-COVID anytime soon. Which means we are going to be experiencing inflation here. Now, PNG does have its own unique events and situations that does cause its inflation to move away from the global environment, normally to the upside. But just like Australia, the broader trends of global inflation matter. So just like the rest of the world's experiencing uptick inflation, it is coming too for PNG. And that is something that's going to be quite important to watch and monitor over the near term. However, global peaking means it should ease as well. And then it comes down to the domestic management. And we'll talk a little bit about monetary policy and how that works too. But the key thing was not experiencing a Back to the Future moment. 85, when the movie first came out, Back to the Future. In the 80s, we had a much less globalisation. Businesses were much more centred around growth. Firms are willing to pass on wage rises, particularly in Australia with a regulated labour market, because they could pass it on in prices. We don't have the same situation we do now. It is more open, more inflationary, but at this stage, it's not a high risk. So I would argue we're not going to see Back to the Future 3, thank God, but we are going to be experiencing higher rates of inflation than perhaps we're used to in the last decade. I'm going to be talking to my colleagues who are coming online now and used to low inflation about how things may be a little different. And food inflation is going to be a big part of that story. Saul talked about the disruptions coming through the Ukraine situation, and it does matter in terms of the hit it gave us to oil prices. But more importantly, it disrupts fertiliser supply chains. We're also having heat waves go through the Northern Hemisphere for the second year running, decimating crops up there, again pushing on prices. So elevated food prices do remain a risk. These prices are in real terms, adjusted for inflation. So they're trying to give you what you think the level of prices are now outside of inflation. And you can see the cost of fertiliser likely to remain quite elevated for some time, along with heat waves, pushing up on food prices. So from an export side, good news for PNG. From the large level of food imports the country needs at this point in time, not so good. So that's the inflationary story. And just to really highlight the story around goods and things and some risks that are going to be emerging in the near term, a lot of discussions around oil prices and where they go. Now, Saul can manage to avoid having to talk about commodity forecasts because he's far more important than to have to worry about trying to do that. Unfortunately, for my sins, that is my job. I have to forecast them, so I have to think about these near-term risks. And one of the things we're experiencing is OPEC Plus, that includes Russia, overall looks fairly maxed out on its production. We're seeing Russian production decline as the embargoes impact. Now, it hit their exports, but not as much as we'd think because, as you would expect, places like China and India, which haven't signed up to the embargoes, are buying Russian oil at a significant discount. What matters more is the fact that they can no longer get materials, skills, technology to run their oil industry. All the Western companies have left. Embargoes on imports means their production is in decline. And until this changes, it's going to be a serious barrier. So increased Saudi exports, increased Venezuelan exports, increased Iranian exports are just going to make up for the lost Russian amounts. So there's no growth in that. The other flip side is that all the growth that we've been seeing in the last decade has come from North America, Canada and the US in particular, and their expansion of the fracking industry. And with this new fear about the longer term investments, focus on short rates of return, fracking is not expanding at the same rate given the current prices. So yes, we've seen the peak in oil prices. Yes, they've come down, but they're back around $100 a barrel and they're kind of holding there. This fear of investment is creating some uncertainties. Now, this is where we have sort of an interesting environment where everyone believes in supply and demand, and in an environment of declining demand, you get declining prices. That is not always the case. In some commodities, you can get declining demand and increasing prices. Now, I'm going to give you the most extreme example, and I'm not going to say all commodities are going to do this, but one of the commodities that we've been trying to squeeze out of our society and culture forever is mercury. Toxic chemical that no one wants to use. Every year we find ways to not use mercury, and the demand for mercury declines. And every year the price goes up. Why? Because no one wants to invest in a mercury mine because supply is declining. No one wants a mercury mine in the backyard because it's incredibly toxic. Demand falls, but prices rise. So you can have prices rising in a declining environment if everyone believes it's a bad investment. Right now, thermal coal from Australia is worth $400 a tonne. Yes, it's to do with Ukraine. Yes, it's to do with the Europeans wanting more coal. Yes, it's to do with the lack of supply in Australia because we haven't been investing in mines in the last 5 years. Yes, it's to do with the amount of rain we've been getting, filling up our mines and filling up our ports with fresh water so the boats can't fill themselves up. But you can see the story here that's unfolding. The investment cycle can lead demand cycles and actually lead you to have undersupply. So the near-term outlook for things like LNG, oil and gas, price-wise, could actually be quite good. Now, it doesn't mean it's not a great long-term investment. It could actually still be bad, but the near-term price benefits and windfall gains that could be achieved must be an upside for any economy, including the current miners in Australia who've set up mines to dig coal out of the ground at $70 a tonne and selling it for $400. Money. So these are our current forecasts. We just like saw, we are arguing, we've seen the peak in demand cycles. Prices pressures are going to be coming back and coming off. That is going to give us this sort of downward pressure. But I want to note, just look at where those prices are ending up after a couple of years. And the scenario I've given you where there's potential upside risks. Prices are levelling just around normal high levels. So it's off their highs, but still relatively solid price levels. So I'm not about to talk about things down. Also note the massive volatility we've been getting in terms of prices rallying through the last year and then coming back again within the last month. This is probably the new norm too, with tight supply and demand conditions where you can get big movements in prices happening very quickly. Now, P&G's inflation forecasts, and this is where there's probably some risks around, are talking about a near-term upside lift to around 6%. Currently in Australia, we're talking about inflation being in the 7s, and then moderating back to the 5s and 4s and 3s, similar to what we're talking about in Australia. So you can see here, at least for the near term, there are upside risks for the underlying forecast from the official family and the ADBs and such about the inflation outlook. And yes, we do expect it to ease and ease back, but easing back to 3.5 may be a big ask in this environment, given that framework I've just given you. The backdrop around the world and in PNG has actually been quite good. Now, this comes from the PNG 100 survey from Business Advantage, the work we work with. And these are actually the factors of the least amount of concern that we've got here. And you'll see there, in terms of what we're looking at, that inflation is well down the list. Now, globally, we've seen near-term inflation expectations for the next 12 months rise as inflation's been rising. But the longer-term 2, 3, 4 year plus expectations for markets, businesses, consumers, even in the US, remain quite stable. So inflationary expectations around the world are reasonably well anchored, and it will take a longer drawn-out shock to shake this. So at the moment, businesses and P&G are doing the same, and that forms a base and a framework which the government and the central bank can work on to bring inflation down. Because businesses are not yet really building in this as being a sustainable thing. It's a once-off event. Also, you also see there too that things like shortage of labour is being a low level of risk. Now you may ask what has been some of the higher levels of concerns for P&G. I didn't put the slide up, but two of the ones that always stand out and have increasing risk. First one is, of course, security, law and order. Other one is around infrastructure as such. So these sort of areas of concerns remain, but inflationary ones are not that high. In terms of growth and where we're going to be getting it from, I have to say P&G has actually been relatively surprising. Yes, COVID led to a big downturn in what was happening through their resource or the extractive sectors, leading to the contraction in growth in 20. You'll see, however, the non-extractive sectors, perhaps one of the only places in the world besides outside of China where you didn't see activity actually contract. So there was some underlying strength and stability that's inbuilt in the P&G economy, given its nature. Yes, a large part of it is built around their non-official parts of their economy. You know, there's the self-sustaining part of it, but a part of it's also around the nature of the domestic economy and the way it operates. You are getting reasonable levels of growth coming in through the non-extractive sectors. Of course, the bounce back we're experiencing this year with the opening of the mines and resource sectors following all these developments will give us an extra kick. And the momentum carries through to next year when you get the 4.7. And then, of course, you see both of them converge back. Now, you can see here that I'm talking about in the near term that while there's some uncertainties around the globe about all these programs and investment in resources, there's some near-term opportunities to make the most of this. And this is going to produce potential greater upside for the, which is what the government's focusing on the resources sector, but also the recovery in the domestic side, given those underlying factors. So, despite the many challenges that P&G's been facing, it came through the COVID period incredibly well. We've got the backdrop of the resource sector, which, quite surprisingly, you can imagine to some extent, was hit really hard with the COVID period. It's come through and recovered and is now part of the source of growth, but also the non-extractive sector has been moving quite rapidly on the back of that. One of the things that we talk about, and one of the things that's giving the economy underlying security, is the liquidity in the system. There is, yes, one of the major concerns about businesses is the fact that they can't get hold of foreign exchange to be able to import goods. It's an ongoing issue, an ongoing problem. It's also created a backlog of liquidity inside the P&G economy. You are hearing of local firms using that extra liquidity to invest locally. That is a source of their domestic growth. It also means that some divorcing of interest rates from the official setting of interest rates to what actually the banks charge. Why? Because they have a lot of cash sitting in their accounts and they don't have to borrow from the central bank at all. So this excess liquidity in the system is holding interest rates down inside P&G, relatively speaking. The Ukraine crisis is having ongoing effects in markets around the world, particularly resource sectors. And I'd love to be able to say it's about to end and make things easy and smooth for us again. But it's pretty clear this is an ongoing conflict, and even if it did, I've already highlighted the degree of the shifts we've been experiencing in the economy. What I really feel is true is both COVID and the response we're getting now from Ukraine is highlighted underlying imbalances within our economies that were there, that were being hidden through the growth period that now come forward. Of course, P&G has comfortable foreign exchange reserves, so the global setting is actually okay in terms of being able to get through some of these more difficult patches. And I do worry about their inflation forecast being revised up. I think the pressures are there and being built. But again, this year should be the peak. And as in response, the PNG Central Bank, Bank PNG, has tightened monetary policy. But again, watch those market rates and how they move. Ample liquidity in the system is providing the ability to keep rates relatively down. So there's a lot more upside than downside. The formation of the new government with such a significant majority has to be one of those clear upsides. You'll see it coming through the forecasts out there in terms of what we're talking about with private sector growth coming through. You've got the current account under pressure because of the import side keeps on coming through. We have a modest inflation profile talking about. We talk about the fiscal surpluses becoming under control under this kind of growth environment. And the GDP from the non-extractive sector. The extractive sector is the backdrop of these big investments, but I think it's really important to talk about the non-extractive sector. And we are talking about reasonably good growth coming through from there next year. And that providing us with a relatively sound backdrop for us to work forward. Now, we do have some research you can sort of quickly gather if you're really interested. It's Westpac IQ. A lot of this work will appear up there on Westpac IQ. Unfortunately, having worked, Saul's working for a private consultancy and he hasn't had to do this, but I am going to have to expose you to my 2 pages of disclaimers about highlighting that I'm not recommending you buy or sell any financial products or actually any form of assets at all. In fact, I'm not giving you any form of direct advice at all, rather than giving you general advice. And my general advice overall is one of, I'm up here to try and provide a group scenario, what we think is the most likely outcome in this framework. I'm trying to make you think about opportunities and risks. And in fact, I feel like I've often done my best job when someone comes up to me afterwards and says, Justin, you raised some good points in your presentation, but I disagree with you for these reasons. That means I've done my job and made you think about opportunities and risks, put together a framework, and for me, that is what will help PNG grow in the future, is those people who are willing to look through the risks and opportunities and make decisions that will generate returns. So, thank you. You're welcome.
Thank you, Justin. There is, just before we go to morning tea, there was one question that came through the app that briefly, if you wouldn't mind answering it, because it was something that made me puzzled. Someone asked a question, Willie, I don't know if you're here, about the recent drop in the bond rate for PNG, which seems to go against the sort of inflationary trends that we've been talking about here. Maybe just in 30 seconds or a minute, you could just explain what's going on there. Is the government simply trying to cut the cost of its borrowing from people, or what's going on there?
I would love to draw one of my colleagues down here who could actually give you a much more introduced, much more detailed answer. But basically, the situation is with PNG having ample liquidity in its own system, its interest rates are being divorced from the global environment. You don't have a globally traded bond market. If you did, I would say in this environment, foreigners would be looking at PNG and saying it's a little bit more risky than the rest of the world, pushing on rates a bit, and also looking at what's going on in the rest of the world and pushing on rates there. The other thing to notice, however, is the unfolding environment in the US and the belief that we're nearing the peak in the cycle and the peak in the inflation cycle has actually seen global bond rates come off, and the Australian bond rates have been falling lately on the back of that. In fact, right here, right now, if you went and tried to get a fixed rate mortgage, the fixed rate mortgages have been coming down because of that reason. So this is one of the things that when you've got to be very, very careful when you're talking about interest rates. It's very, very easy to say inflation up, interest rates should be up. But when you have money being moved around and the liquidity in the system, you can get some results that seem a little bit counterintuitive from time to time. And when you have a market that is pretty well closed off to the global financial market, and one that's focused locally, and one that has a lot of kina and is looking for US dollars, you can produce some strange outcomes within your own bond market.